Hi there, welcome to Kneppy Invest. Time for a technical update, and in today's or this week's technical update, I'll be focusing on the state of the market. So I'll be looking at a lot of indices, including the Nasdaq, S&P 500, even the Dow Jones, also Australian indices like the XJO, XSO. Also have a look at the gold chart and a couple of bond charts. I think the Australian 10-year bonds and also the US 10-year bonds. The main reason I want to do this state of the market is because technically it is looking really interesting out there. And technicals is all about sentiment and psychology. And right now, the sentiment is quite negative and psychology is driving the markets down. And that psychology and that negative sentiment is tending to get a little bit worse because of CPI or inflation numbers and the fear from the market that interest rates will keep on rising. And as interest rates keep on rising, the probability of a pretty serious recession actually does increase. And that's what the market is fearing now. And that is what is driving the share prices of most companies down. Not all share prices, but most companies are moving down right now. But as the markets fall, it becomes more and more exciting. And that's the best way to look at this. So I know a lot of investors in the past have been spooked by falling markets, and that's when they go all to cash. Now is not the time to go all to cash. In fact, we should be researching those sort of companies we want to own for the long term. And this is leading to an opportunity where we as investors can buy quality companies at really good valuations. Now, I am not all in the markets right now. I do have about 35% cash. If I see say the XJO fall below 5,000, I will go all in at the markets. In fact, I will take advantage of a margin loan, which I haven't taken advantage for a few years now, because once the market goes below a certain point, the chances of the markets increasing from there in the next 5 years from that low point is significantly high. It's almost 100% because over time, markets go up. Sometimes we have these bear markets. Sometimes the markets pull back, but these are temporary pullbacks. These bear markets are temporary. The normal state of affairs for all equity markets is to go up, and we need to take advantage of when the markets fall like they are doing now. The only problem is we don't know where the bottom is, but you don't have to time the bottom. That is almost an impossibility, and if you do time the bottom, you're absolutely lucky. I'm not saying the bottom is near. We could see significant further downside from here because no one knows the future. But I think right now it is time to pay attention, time to draw up a watch list of companies you want to own for the long term. And what I've been doing is I've been selling some of my lower quality companies and I've been buying some higher quality companies. I haven't bought all the companies I want because I think there is potential for further downside, but I am adding to my portfolio those sort of companies. And right now, my cash levels are remaining between 33 and 35%. And I'll continue that level unless I see some positive momentum in the markets or if we see significant more selling. And again, if I see the XJO go below 5,000, that is my all-in level for the Australian markets. First chart I want to look at is the XJO Monthly, going back to 1980, and there's a real well-defined uptrend, long-term uptrend for the XJO. Now, this is a linear chart, not a log chart. Now, technically, when I do look at long-term charts, I would focus on the log chart. So even though there is a linear trend here, it should not be linear technically because over the long term, the market should be going up on a log fashion, so a logarithmic fashion or exponential fashion, if you will. But anyway, the main thing here is there is an uptrend, which is depicted by the sloping blue line. Those stars I have here are those times over the past 40 years where the XJO has hit that trend and then we saw a bounce. It's happened 4 times in the past, back in 19 or early 1990s, twice. And remember back then was the last time we had, well, maybe not the last time because of the COVID-19 financial panic, but before the COVID-19 financial panic, that was the last time Australia had a recession. We also saw the XJO hit the uptrend during the depths of the GFC in March 2009. And then we also saw the XJO get very close to that uptrend during the COVID-19 financial panic. So at this point in time, that is the worst case scenario, in my opinion, for the XJO. And right now, the uptrend is around about 4,400 or just above that. So if we do see the XJO get below 5,000, that's the time to get really interested in taking or going all to cash. Now, since the end of the GFC, the XJO has been trading in this upward channel, depicted by these two sloping orange lines. And whenever the XJO gets to the top of that channel, we see some selling. Whenever the XJO gets to the bottom of that channel, we see some buying. Only once during the last 13 years has the XJO broken the trading range. That was during the COVID-19 financial panic. So that was just a one-off. And then we quickly saw the XJO rebound to get back in to that trading range. And right now, the XJO is falling towards the bottom of the trading range. Now, it doesn't mean we'll see another bounce just because of the overall fear in the market, just because of the negative sentiment. I could see the XJO, or envisage the XJO, going below that trading range for a short period of time. But that's my next sort of interested point. And that bottom of the trading range right now is sitting at 6,200, and the XJO is around about 6,400, just above that. So we're near the bottom of the range, and I would expect the possibility or even the likelihood of some buying coming in if the XJO hits that bottom of that trading range, just because of the psychology of the market. So there's a lot of investors out there, particularly those who look at technicals, who know that the XJO trades in this range, and when the XJO hits the bottom of that trading range, they will start buying. Again, it's all about psychology. That's what technical analysis is. It's all about psychology and sentiment. Now onto the weekly chart, and now we've zoomed into the last 10 years, and that upward sloping channel is quite noticeable here. And at one time we went through or broke the trading channel was during the COVID-19 financial panic. For a very short period of time, back in August 2021, I think it was August 2021, we broke, or the XJO broke the top of the trading range for a very short period of time, and then we went below it. Remember back then, we had about 10 months in a row that the XJO was going up. Maybe it was 9 months in a row, something like 9 or 10 months in a row. I think that was 2020, if I remember correctly. And ever since then, the XJO has fallen. Now, I've also got there is also a pretty strong support level at 6,400. And that support level will probably become a little bit more clear when I show you the daily chart in the next slide. But that support level actually was created way back in 2018, just before we saw a significant correction in the markets because the Fed was thinking about raising interest rates back then. That was the top back in 2018, and that has been a strong support level because recently in June, we saw the XJO hit 6,400 and then bounce off it. So again, that is a pretty strong support level, and that's the next level I could envisage being broken. And if we go from 6,400 to about 6,200 to reach the bottom of the trading range, it would not surprise me. So at this point in time, because we are very close to that support level, very close to the bottom of the trading range, I definitely would not be going all to cash right now. I would definitely not be selling out just now, even though there's a lot of fear in the market right now, even though we've had quite a few weeks, I think 3 weeks, where we've seen significant downside to the market. I do think the market is oversold, and I would expect a bit of a bounce over the next few months. Now onto the XJO Daily. This goes back to July 2020, and I've kept the trading range in here and also that support level at 6,400. And we saw the bottom of the market in June reach 6,400. Then we saw a bounce, and it was a nice bounce, a nice little bear market rally going from 6,400 to 7,100. And because the market actually at that point in time in that rally rose more than 20%, there were actually some commentators out there calling this the new bull market and saying the bear market didn't last very long. But again, they were fooled because this was just a bear market rally. And in all bear markets, we see these sort of rallies. If you go back to the GFC, go back to the tech bubble burst, back to the Great Depression, these sort of bear market rallies were all too common. And we have already seen one. We also saw one earlier than that. I think the XJO, or maybe it was a Nasdaq, rose about 17% in a short period of time. Now, in saying all that, the XJO has pulled back from 7,100 to just above 6,400. So we're getting very close to that support level and getting very close to the bottom of the trading range. So a lot of support between 6,400 and 6,200. So I wouldn't be surprised to see the XJO, unless we see significant downside on the American markets. I wouldn't be surprised to see a bounce from here, or the XJO hit top of the bottom of the trading range, and then we see a bounce because of all this support, because of all this buying coming in from these technical analysis who see support levels between 6,200 and 6,400. Next chart I want to look at is the Nasdaq weekly going back to March 9, 2019. Some really interesting things when I look at this chart. The first interesting thing is that the Nasdaq has fallen through a support level just under 11,200. We've seen the Nasdaq down pretty big over the last 3 weeks, and we would like to see a little bit of a rally over the next week. So this breaking of this support level has not been confirmed, because otherwise the next support level is just above 9,600, which was created just before COVID-19 financial panic. That was the high in the Nasdaq. So there is potential that will be the next support level for the Nasdaq. But probably the most interesting aspect about the Nasdaq weekly, and I think this is also true for the S&P 500 and the Dow Jones, is a setting up of a downtrend. And that downtrend is depicted by the sloping dashed line. So all you have to do to draw a downtrend is just to look at the peaks. And if all those peaks align, which they do in the Nasdaq, and I'm pretty sure they do in the S&P 500, S&P 500, and also the Dow Jones, you have a downtrend. And if the Nasdaq keeps hitting this downtrend and pulls back, that makes the downtrend more and more popular. So why is a downtrend important? Because that downtrend is what we want to see broken in the future for us to become more, have more positive sentiment, for the psychology of the market to change. And without doubt, there's going to be a lot of technical analysis who see the setting up of this downtrend. And again, if the market keeps hitting the downtrend and then falling back, it makes it more and more powerful, which means more technical analysis become more interested in the breaking of that downtrend. And then when it does break, and it will eventually break, I can almost guarantee you, the Nasdaq weekly downtrend will be broken at some point in the future. That would be the sign to start buying. And I'm not talking about me, I'm talking about those the short-term traders who will see the Nasdaq downtrend broken, and that's sort of their sign to go all in, to start trading the Nasdaq and to become bullish as well. Next index I want to look at is the Dow Jones weekly. This goes back to March 2019, just like the Nasdaq. In fact, this is a fairly similar chart than the Nasdaq. We have that downtrend and a well-defined downtrend, and the two last peaks we have seen in the Dow Jones have hit that downtrend, and then we have seen it pull back. The last pullback has lasted 6 weeks, and it's been a fairly significant pullback for the Dow Jones over that 6-week period. Not only that, the Dow Jones has fallen through a support level at around about 29,500, and that support level was pre-COVID-19 high. So yes, the Dow Jones right now is lower than pre-COVID-19. So that is a pretty good support level. So unlike the Nasdaq, which has a little bit more to fall before it gets to those pre-COVID-19 high levels, the Dow Jones is now below those levels. So interesting chart here for the very fact that that support level has been broken in the past week. Now onto the S&P daily. So instead of looking at the weekly chart, I'm looking at the daily, and this goes back to August 2021. We can see the high in the S&P 500 around about the 1st of January, or maybe the 2nd of January. And then we saw 2 more peaks, just like the Nasdaq and the Dow Jones. The first peak was in late March, and the second peak was in the middle of August. So if you draw the line from the high we saw at the start of January to the second peak to the third peak, they align perfectly. So again, this is a perfect downtrend in the S&P 500. And the reason why it's so perfect and why technical analysis works is because the movement in indices, the movement in company share prices is all about psychology and sentiment. So as the S&P 500 back in the middle of August hit that uptrend or downtrend, there would have been some selling. So there would have been a lot of fund managers, a lot of those who do look at technical signals, who saw the S&P 500 get to that downtrend, and that was the opportunity to sell out of some of their companies, and that's what put some selling pressure into the S&P 500 and also the American markets. And there was also a nice little support level at 3,640, and that was the lows we saw back in June, and the S&P 500 has fallen through that level. Now, the S&P 500 is still above pre-COVID-19 highs, just like the Nasdaq, but this does look a little bit more bearish than some of the other indices. But again, just like the Nasdaq and the Dow Jones, that downtrend we see that has developed over the past 9 to 10 months is really important. And when that downtrend is broken, is going to be exciting times for the market and for investors. I have no idea when that downtrend will be broken, but it will be broken in the future. It is almost 100% guaranteed. Now, there's no 100% guarantees or absolute 100% guarantees, but this is one of those that is near 100% guarantee that this downtrend will be broken. And when it's broken, that's the time to get excited as an investor. Next chart I want to look at is the XJO daily. And to be honest with you, the XJO is technically very, very well behaved. And what do I mean by that? I mean that support levels and resistance levels are barriers for the XJO to get below or above. Not only that, if you look at the last 6 months of 2021, there is a triple top there. So if you look at level 3,600 on the XJO, it really had a hard time getting above that level. So we saw the XJO reach 3,600 3 times, and then the last time was like on the 2nd of January. And remember, the 2nd of January was the peak in the S&P 500. And ever since the 2nd of January 2022, the XJO has been falling. Now, the first support level was 3,100, and we saw the XJO reach 3,100 towards the end of January. Then we saw a bounce. So that support level held firm. It tried to test it again just a month later, and then we saw another bounce. But then in, what was that? That was May. In May, the XJO fell through that support level on strength, a very big down day. So that meant that support level became resistance. Over the next month, we saw 3 occasions that level, 3,100, was tested. And remember, that level now had become resistance, and the XJO was struggling to get above that. So that was a barrier for the XJO to get above. And then we saw a major sell-off in the XJO during June. It fell all the way down to 2,620. So that was the next support level for the XJO. And then we saw a significant bounce. And where did the XJO go to or get to? It reached 3,100, the old resistance level that was set up back in, when was that again? Back in May. And then we saw it pull back. So again, that resistance level at 3,100 held firm. The XJO tested it, and it was a strong resistance level. And then we saw the XJO fall all the way back to that support level at around about 2,600. And then we have seen over the last 4 trading days, I think maybe it's 5 trading days, the XJO just goes sideways. It doesn't know if it wants to go above or stay below that support level. If we do see a lot of selling coming in over the next few weeks, and that level at 2,600, the XJO falls well below that level, that means 2,600 would become resistance. So that's why I'm saying that the XJO is a technically very, very well-behaved index, which actually did surprise me. I wouldn't think this sort of index would be technically well-behaved. The next chart I want to show you is the Australian 10-year government bonds. I'll just call these bonds from now on. This is the daily chart going back to August 2021. And there's one main reason I want to show you this chart, because this particular bond has been an uptrend, just like probably every other bond, since the end of 2021. In fact, it has risen, or the yields have risen from about 1.5, 1.6% to a high of 4.1%. But at 4.1%, which is displayed by the dashed line, that looks like it could be a developing strong resistance level and a possible double top, because back in June, we saw this bond get up to that level and then pull back. And then recently, this particular bond got back up to 4.1% and has pulled back again. So maybe the upwards limit of this particular bond yield is 4.1%, which may be good news for anyone holding government bonds, because don't forget, bond yields and bond prices are inversely correlated, which means if government bonds have been going up, bond prices have actually been falling since the end of 2021. And it also could be quite positive that if that is the limit of bond yields, that would also be good and positive for equity markets. But it remains to be seen if 4.1% can hold firm. Now on to gold. And to be honest with you, I'm a little bit surprised that gold has fallen through a pretty strong support level at just above 1,675. It went through that level 3 weeks ago. And the reason that level is strong, because about 4 times in the past 2 years, gold prices have hit that level, and then we have seen a bounce. So it has been, gold has been trading in a range between about 2,070 and 1,680 for about 2 years. And recently it has gone below that range. So right now, gold is in a downtrend. In fact, I call it a short to medium downtrend, and we have no idea how much lower gold can go from here. But I do think, this is just my opinion, we will see a bounce in gold prices eventually. So I'm holding on to 2 gold companies at this point in time, anticipating a little bit of a rebound in gold prices. But I could be wrong, because again, that is the future. I'm talking about the future, and the future is absolutely unknowable. No one knows what's going to happen to gold prices in the future. That's just me anticipating what I think is rational behavior of the market. Next chart I want to show you is the oil weekly chart going back to 2018. And oil, just like gold, has been in a downtrend for the last few months. In fact, oil prices have fallen from about $120 a barrel to just around about $80 a barrel. So that's a 33% drop in oil. Really haven't seen that translate to petrol prices just yet. And petrol companies will say it takes about a month before that translates to lower petrol prices, but really hasn't translated at all just yet. Maybe it's because the excise that's come back in, if I remember correctly. Anyway, back in 2018, oil prices actually reached about $75 to $76 twice, and that's a really strong, or that was a resistance level for oil. Had trouble getting above $75 back in 2021. It took a lot of time, a lot of effort to drive oil prices above that resistance level. And that resistance level, once it was broken, became support. And oil prices have moved towards that support level. So just above that support level right now. So wouldn't be surprised to see oil go sideways around these levels for a bit of time. If it falls through $75, that would be really good news for those who want lower petrol prices, maybe bad news for those owning oil companies. The next chart I want to show you is a comparison, a Nasdaq monthly comparison, looking at the tech bubble, what happened on the Nasdaq back then, comparing that to what's happening right now. And there's a lot of similarities between the two. So what I've done is brought the tech bubble in line with the present day, which means we're looking at the first 10 months of the tech bubble burst. And what's really interesting in this exercise is looking at what happened with the Nasdaq after those first 10 months. In fact, the Nasdaq kept on falling for like over a year after the first 10 months. Now, that does not mean the Nasdaq will keep on falling from here over the next year, over the next 15 months. It's just what happened during the tech bubble. But it's just showing you that even though the tech bubble kept on falling, the Nasdaq kept on falling during the tech bubble, we don't know the future. This could be the bottom in the Nasdaq right now, and then we could see a new bull market, a long-term bull market, or the Nasdaq could keep on falling from here because of negative sentiment, because of psychology of the market, because of what's happening in the overall world. So a lot of uncertainty moving forward right now. And typically, because equity markets want to go up, there's much less certainty. But right now, we are in unique times that don't happen all that often. And that's why a lot of commentators will compare what's happening now to the tech bubble, or maybe to the GFC, because those sort of situations, or even to the Great Depression, because those sort of situations don't happen all that often. Now to one of my favorite charts of all time, and this is looking at the 10-year US government bond yields. And don't forget, Bond yields are inversely correlated or related to bond prices. So if bond yields have been falling, bond prices have been going up. So there's a 40-year period here where bond yields were falling. That meant there was a 40-year period where bond prices were rising. And that's why that 40-year period is referred to as the greatest bull market of all time. But it's looking likely, particularly what's happening with bond yields over the past 9 months, that this greatest bull market of all time has come to an end. But what's really interesting about this chart is the correlation between rising bond yields and a correction or a bear market in the Nasdaq. If we go back to 1994, there was a rally in the bond yields and the Nasdaq corrected 16%. In 2000, there was a government bond yield rally, and that coincided with the tech bubble burst. Preceding the GFC, there was a bond yield rally, and that coincided with the start of the GFC. Back in 2018, there was a bond yield rally. Remember, in late 2018, the Fed was threatening to raise interest rates, and that's when we saw the Nasdaq correct 17%. And right now, over the past 9 to 12 months, we have seen the mother of all government bond yield rallies. In fact, the US 10 years have risen from 0.5% to 4% right now. So no wonder the US equity markets are down big since the start of this year, just because of this rally in the US government bond yields. That's all I have for this technical update, looking at the state of the markets, focusing on the equity markets in the United States and Australia. Also had a look at the gold and oil markets and the bonds as well. If you have any questions, any thoughts, leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.